Rick, I'll start with you. Clearly, we saw a bit of a yo-yo session for most of the bond yield, but the 30-year really falling quite significantly lower by the end of that press conference.
No, you're right. Whether you look at 10s minus 2s or 30s minus 5s, two favorites on this floor, they both have mild flattening. We may have charts up. Make sure you pay attention to the scaling. We're not talking about big moves, but you're right on the spirit of the move. To me, if I take a step back, here's what I see. We failed at 311 on the lead up to the Fed meeting, expecting a rate increase. We got it. They removed language with regard to accommodation, and I agree with the chairman. I don't know that that's that big a deal. What we walk away with is a market. I wouldn't say that our days of trading over 311 are over. What I find is you need to let this simmer through a bit. To have a chairman, and Steve just nailed it. Listen, they never have their feet on the ground with respect to policy, and since the credit crisis, it's more like being in outer space, anti-gravity. You just don't know if you're standing upright or not, and I think this chairman understands that. He understands the limitations of modeling, understands the limitations of forecasting, but more than ever, I think he also understands that there's lots of policy collateral damage if you really get focused too much on trying to combat inflation that hasn't shown up, or why the unemployment rate is falling so precipitously. You know, are those affected in equal helpings by the policy that is supposed to move them? A pragmatic Fed governor at this point in time is a real asset to the U.S. economy.
You can say a lot stylistically about the news conference, Art, but one of the biggest questions was, what does that removal of the word accommodative mean in terms of policy? The chairman said nothing. How do you read it?
Well, it's not nothing. I mean, it's a modifier, and it's a descriptive modifier. Accommodative means that we're doing a little extra to try and accommodate the economy and move things along. So what the chairman did right now was he pulled a Goldilocks. They took accommodative out, and he said rate policy is just right now. And that means that, you know, people are talking, we're below what the real rate should be, et cetera, et cetera. He's saying this is very close to what the temporary real rate should be. He said a couple of other important things. He said the dollar is the matter for the Treasury, but we're watching it. And he's very careful to say it. And he talked about trade, and they're watching it. So the Fed is really caught up in a variety of other things, and that's a message to traders what to keep an eye on.
Allan, Rick mentioned there that the 10-year kind of tested 311 and it's come back off that level. Do you think we've peaked in terms of yields for the short term? Would you be a buyer of bonds at the moment?
So I bought my first Treasury bonds in a very, very long time. It used to be that you couldn't, you know, buy Treasury bonds and also have any self-respect at the same time because yields were so very low. I like the 2-year bond. The 2-year bond is like that's part of the yield curve where I think you get a lot of value. I bought some 2s yesterday. I got a yield of like 286, you know, and that yield is right around the same place today.
Rene, I know you're focused on ETFs. I would just point out that the Dow has gone negative. It's down 14 points. Any big moves to make as a result of what you heard and saw in the Fed statement and that news conference today?
Well, I kind of expected that, and I do expect that we're going to continue to see rate rises. So, you know, as far as I'm concerned, investing in the market right now is like playing a game of hopscotch. We really do have to know what to jump over, what not to be in, and what's the best places to be in. I think, as Fed Chair mentioned, it's too early to know what the effects of the tariffs are. And so as a result of that, I'm still focused on the small cap marketplace using ETFs. I am an ETF girl. And I think it's going to be another quarter or two before we actually see what kind of impact there's going to be. So there still is some great opportunities there. The cybersecurity space is also an area to watch. Now, we've already had substantial issues and problems with regards to hacking, but now we have social media platforms that are making that a priority. And I think this is an area that is going to be tremendous. Finally, financial services. Now, also there was a mention of that with rise in interest rates. That's going to be an increase the profitability for a lot of our major banks, even though they've had quite a bit of pressure on them over the past few years due to the financial crisis. But we're over that. We're 10 years out. And so I see that whole space really increasing substantially. One other thing I will add, which is the energy sector too, which is a top performing sector of the year as well.
Art, we saw the high of the session right on 2 p.m. when we got confirmation of the rate hike. We're now at the low of the session pretty much as we approach the close. Does that make sense to you?
Yeah, a little bit. As I said, I think by removing the word accommodative, he pretty much said we might be at the spot where rates belong right now. And I think after some reflection, the market is probably saying, wait a minute, then things aren't quite as easy as we thought they should be. And they're no longer going to be, if you would, ahead of the curve on the economy. And that, after some reflection, that's why I think you're seeing stocks go slightly negative. It's not the end of the world. Some of those other things are important too, about them looking at the dollar, not being in control of it, and trade.
Steve, go ahead.
Yeah, Art, I was just wondering how much the market thought it could have strong growth and low rates too. Isn't the Fed kind of stepping up and saying, look, if we're going to have this strong growth, we're going to have higher rates. In fact, we may have rates as high as 3.4%. You now have a situation where, 12 of 16 now are forecasting the fourth rate hike in December. And I think it's something like 11 of 16 see 3 rate hikes next year. So it looks like we're headed for 3%, barring some weakness in the economy or some decline in inflation at this point.
Yeah, I think you're right, but I think that the market thought we were in a kind of magic sweet spot where the Fed would be cautious enough that they wouldn't keep moving ahead. And that's why if you look at the differences in things, the yield on the 10-year is amazing. And my smart new friend Allan here, who bought those 2 years, they're up where they were when Lehman fell. So you're seeing some, and that's again based on the Fed. So I think we're moving out of that sweet spot, and that's why the market's pulling back.